bond market, would you believe, new territory, and of course, what the future holds. And to join me in today's exciting conversation, I have first Krista Tukanainen, who's our Head of Research and Reporting for Market Intelligence at the Climate Bonds Initiative. And she's going to kick us off with a few slides and images from the report, so you can get what's in there. In the chat function, as well as in social media, we'll be posting links to the report so you can download it. It is such a cool report. Graphics, pictures, not to mention, of course, classic Climate Bonds Initiative data and views. And then to discuss the market, where we are now and where we're going. And when I say the market, remember we're talking about green, social, sustainability, and COVID here. And you're going to find out more about COVID in a minute. I am really thrilled to have with me today Julie Becker, who is the Deputy CEO of the Luxembourg Green Exchange, the Luxembourg Stock Exchange, anything to do with exchanges in Luxembourg, and my co-conspirator around green for so many years. It's a delight to have you again here with us, Julie. We have Elena Panomarenko from the IFC, who has a title Head of Funding Europe for the IFC Treasury, which basically means she does green bonds, everyone. I mean, she does other stuff, I know too, but the only thing that's important is green and social and SDG from my perspective. So she's going to provide the IFC. And for those of you who don't know, we have this market today, in my view, because of the IFC. Because the IFC some years ago issued two $1 billion green bonds, benchmark size, and the scale of response globally was such that every banker in the world noticed. And soon after that, within 6 months, we had a corporate bond market that started. So we owe a great debt to the IFC's work, putting aside what it's done recently. And then finally, we have Jeroen Voluwen. Not finally, because he represents the money. So Jeroen is from PGGM, an important, big, and I have to say, revolutionary fund manager in the Netherlands. I mean, the Dutch fund management industry has been a leader in social investing and responsive investing for some years. PGGM and their colleagues over at APG have also been very good, I have to say, have been real leader. But Jeroen's got a really interesting fund. I'll let him talk a bit about it, which is why we keep bringing him out to join us in our webinars around sovereign, green, et cetera, et cetera. So that's the conversation, that's the crowd. I think now we're fully live on Facebook. This is being recorded. It will be available at climatebonds.net/webinars, as well as on our podcast channels at Apple, at Google, etc., and Spotify. You can come back to it, in other words. You can ask questions in the chat in the Q&A function, I should say. If you do ask questions, we will either answer them in text, or we will try and pick them up in the conversation, or we'll come back to you later. I can't promise all questions are going to be answered, but try me, because I'm keen. That's it. Krista, you're kicking us off. Tell us a little bit about what's in this report, the highlights, what we need to know, which is going live now, folks. I'm about to publish the URL in the chat function. But you'll have to listen to Krista for a bit first.
Thank you for the introduction, Sean. On my behalf as well, thank you very much, everybody, for joining us today in this very exciting moment of us sharing with you our findings on the global sustainable debt market in the age of COVID-19. So, as Sean mentioned, I co-manage the Market Intelligence Department at Climate Bonds, and our team has been looking into the developments during this pandemic and obviously over a number of years, and we found some really exciting things that we wanted to share with you today. So just to give you a bit of background as to why we set out to do this, what is basically a special report for us, deviating a little bit from our regular publication schedule, where we would be doing one report every year looking at the entire calendar year. The obvious thing is the ongoing COVID-19 pandemic. But in addition to that, we've been discussing internally and with our wonderful stakeholder groups for several years now, the fact that there are actually so many different pathways to reaching the commonly agreed targets of the Paris Agreement of a decarbonized society by 2050. The green bond mechanism is one prominent one, which we have been very sort of prominently featured in trying to sort of ascertain what the definitions are and who's active in this market for the better part of a decade now. But we've also seen the rapid emergence of sustainability and social labeled instruments that direct their use of proceeds to multiple categories across reaching different social and environmental outcomes that can also lead us towards a zero carbon society. So in the spirit of the first decade of CBI, which we're celebrating this year, as well as our very successful conference on green transitions that took place just over a month ago, we decided to start broadening our analysis and tracking function of these market segments as well. So what the universe actually looks like and looked like to the end of the first half of this year. We had identified almost 900 billion green bonds that align with the climate bonds definitions and meet the screening criteria that we've set out in our database methodology document, which is all public on the climate bonds website. In addition to that, we've also seen almost 175 billion USD of green bonds that carry the label but don't meet our definitions, whether it's due to actually non-aligned use of proceeds by way of the projects and assets financed, or a lack of disclosure where we're unable to make a determination about their inclusion. Outside of that, we saw over 200 billion USD equivalent of sustainability bonds, so financing a mix of social and environmental categories, as well as about 86 billion of social bonds that carry that label. And as a subset of that, a new entrant this year, for obvious reasons, the pandemic bond label, 75 billion USD. And Sean and I will discuss this with the other participants later today as well, about how in addition to this, we've already almost reached the 1 trillion USD mark with the green bond market. And we've seen a record amount of issuance this past quarter, the third quarter of 2020, actually reaching a record of any quarter of green issuance ever, almost 70 billion. And there's reasons not just for the volume to be optimistic, but also that number actually contains 52 deals that are benchmark size, so more USD 500 million or more, as well as over 70 new entrants to this market, which is something to really celebrate. And it's an indication that the market is actually bouncing back much faster than we thought. So just a moment to take a sort of brief look at how we do the screening for this sustainable debt and enlighten you a little bit on the definitions that we use. So as I mentioned before, we have our green bond database, which has existed for nearly a decade now. We start by looking at green bonds that the issuer themselves has labeled as such. And then we screen each instrument down to its use of proceeds. So what is actually being financed? What are the eligible project and asset categories and examples therein? If it's aligned, it's tagged as such and it goes into our database. If not, also tagged as such and tracked under a separate function. And if we need to ask questions, then we'd get in touch with the issuer to ascertain that. For the other labels, we don't yet have similarly stringent screening criteria and a comprehensive taxonomy, although we're very aware of the developments that are going on at the European Union level and elsewhere, also in-house for us on trying to develop something therein. But what we also do with these is we look at the label and then we group these deals by whether there's a mix of social and environmental categories, therefore constituting a sustainability bond, or if the deal is exclusively geared at financing social outcomes, then it would be tagged as such. And the pandemic bond subset, as I mentioned before, is just that. It's a subset of the social database segment, as it were. And because also there's a lack of strict definitions as to what should and could be included in those types of deals, although we've had discussions with ICMA and others about this, and there's guidance out there in the market, which is very welcomed. We do this based on the labels only. So there's a host of labels for all of these categories, which you'll see if you look at the report and scroll down to the annex. You'll actually see all the different labels that we've captured under these three broad themes, and four if you count the pandemic. So what does the actual first half of the year look like? We've definitely been quite surprised about how even the thematic split has looked like already in the first half of this year compared to any of the previous full calendar years. And we are seeing this continue into the third quarter. So as you can see from the graph on the left-hand side, these bars are much, much more even, whereas the green theme dominated in previous years. Similarly, on the volume side, on the monthly split, when the WHO declared the COVID-19 virus as a global pandemic in March, we saw the sharpest dip in volume then, and concurrently the highest volume in the pandemic labeled issuance. And if we look at this on the other side, whereas the previous slide was on volume, so the actual amounts issued, if we're looking at the number of issuers, it's interestingly quite different. So the pandemic issuer pool, let's say, made up more than 60% of the entire pool of issuers in the first half of 2020. So it took the sustainable debt market by storm. And interestingly, also the issuer count, so the number of entities issuing these labeled bonds, was much, much less volatile than the volume. So we've actually seen the numbers remain fairly consistent for the green, sustainability and social bond issuers. Obviously, the COVID and the pandemic theme being a new entrant looks a little bit different. And what I'd like to leave you with today is just to let you know that also, in addition to just launching this report as a PDF, we've also published a new data playground. So if you like to go and look at the findings in more detail, there's a website link here, but also you can access it through the main Climate Bonds website to go and slice and dice the numbers per geography, per issuer type, and a number of different deal characteristics like size and tenor and currency. So you'll see a lot more detail there, but I don't want to take up the lion's share of this conversation with the data. I hope that's a helpful short overview, and looking forward to the subsequent discussion. Thank you.
Krista, thank you. That's great. The link to the report is now pasted in the chat function. Have a look, download it. It's quite a long report, but it is so cool. So please do look at it. Now, our panelists, I'm not going to give a speech now, by the way, Julie, just so you know. I'm going straight to you. So Julie, your thoughts, your perspective. We've got the report, you know what's in it, in the market now. What do you see happening? And of course, I will want you all to go to where you think the market is going, because that is very much on everyone's thoughts at the moment. You're on mute still.
Sorry. Thank you very much, Sean, and thank you, Krista, for the presentation of this very interesting report. I have to say that the global trends are very well also reflected on our exchange, and that the green was indeed always dominating in the previous years, but the global pandemic has clearly brought the social aspects, or the S in ESG, to the fore, and reinforced clearly the awareness that finance needs to be part of the solution. If I come back to figures, the amounts issued this year on our exchange, the split is of 35% for green versus 65% for social and sustainability bonds. While last year, same date, end of September, in terms of amount issued, the split was for green approximately 60% versus 35% this year, and social and sustainability bonds combined 40% versus 65% this year. July and September were, however, very active in terms of green bond listing at LuxSE, but green bond listing activity was very low in March, June, and August, which reflects as well the global trends that were just presented. Maybe back to April 2020 on LGX, what happened with the pandemic. It's very interesting to know that for social and sustainability bonds that were issued and listed from January to April 2020, the amount issued in 2020, already after 4 months, exceeded the total amount issued in 2019 for social and sustainability bonds. And April was even an exceptional month for the issuance of social bonds for a total amount of $7 billion, while the monthly average was $1.2 billion in 2018-2019. There was also a great diversity of issuers, banks, Natixis, BNP, National Bank of Canada, Access Bank in Nigeria, corporate, Iberdrola, Eurofima, and development banks, 8 of them, EIB, World Bank, IFC, of course, Council of Europe, African Development Bank, Cassa Depositi, KfW, Swedish Export Credit Corporation. So huge activity, really increased by compared to what we know usually. And more social bonds, of course, issued. For example, with the AFDB, which issues on average 1 social bond per year, issued 2 bonds, social bonds, within 2 weeks in April. Lots of COVID-19 emissions, in which development banks were very clear in their objectives that they were raising funds to fight the current crisis related to the epidemic. A great diversity of development banks, and the amounts issued were much larger than usually. These issuers often issued hundreds of millions of euro per tranche, but here we saw more bonds in excess of 1 billion. And the AFDB again issued a $3 billion, which was the largest ever, and got an award for its Fight COVID bond from Global Capital. The World Bank as well issued a $8 billion sustainable development bond back in April, the biggest US dollars denominated bond ever issued by a supranational institution. And you wanted to us maybe to mention it, what a fantastic day yesterday, a defining moment in sustainable finance. 64% allocation of ESG investors, something 13 times oversubscribed, 17 billion euro of social bonds in one go. And it's just the beginning, creating debts, creating liquidity. So which issuer can afford not to be part of this movement today? It's clearly a new era that starts in capital markets. And it's not only numbers, it's the fact that in the investment community, the who's who of investment side support social bonds in the EU that are very much oversubscribed.
This is a pretty amazing transition we're having this year, isn't it? I mean, for the listeners, these are, I'm going to claim, the daughters of the green bond market, because they use the same use of proceeds idea of the green bonds market, the same basic rules. The ICMA Green Bond Principles has now issued very similar rules for social bonds, sustainability bonds, green loans, etc., with other parties and green loans, because it's all part of the same kind of idea, which is that you can borrow full faith and credit or whatever, and you then promise to also, cross my heart and hope to die, allocate the proceeds to something that will do good. And there's a question about what will do good, which we're going to come to. Jeroen's going to take us into that space. But the key point is capital with purpose is now front and center and mainstream. Julie, in 5 years since we've been talking, this is a revolution, isn't it? Like, it's something to be proud of about how capital is changing.
Absolutely, Sean. And there's no way back, but we want more.
There you go. Fantastic. So on the question of more, Jeroen, over to you. Your thoughts, including your thoughts on the social bond, but your thoughts on this market, this explosion, and of course, what you're doing to make it grow, which is a fantastic story.
Thank you very much. And congratulations also on your 10-year anniversary. I mean, it's exciting, but it's also a lot of new type of bond instruments to keep track of. We've also seen SDG-linked bonds. We've also seen sustainability-linked bonds by the likes of Novartis and Suzano. So there are a lot of innovations happening in the bond market right now, which are at such a pace that we haven't seen before. Perhaps on the green bond side, first of all, we've also seen some other very exciting examples, and one of them is Egypt. Egypt issued a green sovereign bond quite recently. They included various environmental projects. There's wastewater projects underneath them. There are seawater desalination to achieve clean drinking water. The Benban solar project, which is one of the largest solar projects in the world, will be partially financed by this, or a late stage of it. So the Egyptian bond is one of the better green bonds we've seen. Indonesia has always been a very good issuer, very good framework, very good use of proceeds, very good commitment to reporting, informing investors very clearly about it. And actually, we also had the German one quite recently, but ironically, there's still some criticism by some parties, even like MSCI, who also does a verification, mentioned that they are looking a little bit careful at how this use of for research and international cooperation is being used, because it's a less concrete, a less tangible use of proceeds. In the social bond space, as you rightly point out, the daughter of the green bonds, we've also seen the Ecuador example, the social housing bond, which is a very clearly defined project, very good use of proceeds. They were advised by the Inter-American Development Bank. At the same around about the same time, you also had Guatemala, but Guatemala didn't go for verification or a second party opinion and kind of said, I think we comply with the framework. And that's where the gray area starts to emerge. And I think where the investment community should remain critical and skeptical and also challenge the issues on them. And we're going to talk about the EU deal as well. And there you can also, if you read the use of proceeds, it's obviously directed towards 17 countries. It's obviously a critically important component. It's mostly unemployment financing for people who lost their job or are in short-term or like flexible wage contracts, and this is an employment benefit. But at the same time, it's going across 17 countries. Every country has to report back to the EU Commission on how they're using the proceeds. So that means 17 different ways of reporting. How are you going to aggregate this? How are you going to track how many people this reaches? And also, I think they put two SDGs. One is the economic benefits, and the second is healthcare. But if you read the framework very carefully, it actually says the healthcare is an ancillary part of this framework. So an alternative would have been, we actually invest this money in reskilling people as opposed to a simple handout. So I think that is where investors should always very carefully look at how are the proceeds used. And I think a second party opinion provision or verification is always an essential part of issuance.
That's a great point to get it. And I couldn't agree with you more. And I think when we look at the rapid growth of social, sustainable, and then COVID and pandemic bonds, it is a bit like the green bond market was 10 years ago, where it was a bit of a wild west, kept in train by development banks and investors and commenting on stuff and underwriters, and it got to a good place. But we've seen some crazy stuff, you know, in the COVID bond market, which started in China, where I think we've seen, what, 47 billion or something like that, Krista, issued so far. So there are a couple of bonds issued by oil companies for working capital. And I'm sort of thinking, I don't know, I'm happy of that, especially in the context of understanding the pandemic, right? Because this is a climate change incident. This is about pathogens jumping between species as a result of degraded environments, in this case in southern China, and a few years ago it was in Egypt for bat colonies and MERS virus, etc. We're going to get a lot of these, according to the IPCC Health Committee. It's going to be a regular occurrence in the 21st century because of our rapidly degrading environment. So we need to prepare. And what we're learning from the current pandemic, a couple of things. One is that when we make our societies resilient, there's stuff to learn about what not to do and what to do. We've seen some spectacular successes in health system investments in the last year. One of the SDGs, for example, in South Korea and Taiwan. We've seen some spectacular failures in health system investments, notably in Western Europe and the US, in terms of its impact on ordinary people. We've got to learn what that means for further detail and elaboration around health system investments in the social category or the SDG category. We need rigor here. But of course, that also relates to mitigation. We've had the managing director of the IMF say, we have to build back better. Isn't she right? Well, one of the things about building back better is we don't want to support institutions or rather investments that have contributed to the collapse of environments and that's led to pandemics. That kind of means we don't want to support legacy fossil fuel investments. So when I look back at that bond issued, a COVID bond issued by an oil company in China for working capital, I'm thinking, is this looks a hell of a lot. There's not a lot of, strictly speaking, COVID stuff in there. It looks like propping up an oil company, which is exactly what we don't want to do. So this is a discussion we have to have about what are the rule sets around social, around COVID going forward, so we have a better idea of what should be in there, and more to the point, make the market grow faster because we have confidence in the rule sets. Well, I don't know, Jeroen, that's my pitch. Am I mad? Is this a reasonable argument?
No, I couldn't agree more. I think the beauty of these kind of structures is the whole package, meaning verification, reporting, use of proceeds. And we need to uphold this credibility of these frameworks. And once we start to get into a gray area, we get on a slippery slope. I mean, the key is for an issuer to raise its credibility, for the investor to have targeted investments. And lastly, I think, which doesn't get highlighted a lot, is that certain governments may have short-term interest to have finance handouts to either SMEs or to the public, etc. Whereas that money should be going towards medium to long-term investments that raise the total economic growth, raise the factor productivity of its people. And that means looking beyond your own election cycle. And that includes also green infrastructure, water sanitation, public transport, etc. And it is the green bonds essentially are the carrot to finance these more long-term projects. And that's why we need to make sure collectively investors, but also the banks that help them underwrite the deals to uphold the standards.
So there's work to be done. But of course, like the green bond market, the horse is running, so we've got to catch up. But like the green bond market, we will catch up, and you will see a rapid proliferation of discussion and rule sets in this area. It's certainly on the agenda of the sustainable finance taxonomy work, the EU platform that I've had the privilege of joining, and Julie has been so important helping develop and create, and so has Jeroen and so on. So we're going to see more out of this next year. The question is, will we move fast enough? In the meantime, keep your eyes open and be critical. The good thing we've done, we've established a market where transparency is the norm as a rule, and you can critique, which has not been the case in bond markets in the past. And that's the big achievement. And I've got a lot of investors now who say the thing they like about sovereign green bonds is the reporting and transparency. They prefer them to ordinary green bonds because of that. And I think we're going to see more of that. Of course, this begs the question of, is this working in emerging markets? So, Elena, you're head of funding in Europe. You've got to talk to the European investors like PGGM and so on as part of your fundraising program. But you're also part of an institution that has been absolutely critical in growing issuance in emerging markets and engaging around emerging markets. What are your thoughts, based on what we've said so far, about where this is going, what the future, what's happened and what the future holds?
Thank you, Sean. It was certainly fascinating to hear the discussions, and congratulations on the wonderful report. We had a sneak peek into it, and congratulations on the 10 years, which serendipitously coincides with the 10-year anniversary of IFC becoming a green bond issuer. Clearly, I mean, the social aspect of the S and ESG have been integral to IFC's DNA. I mean, after all developmental institutions have this within our mandate. And explicitly financing climate smart projects. We have been, we financed, provided over 28 billion of financing to the climate smart projects. And because we're a developmental institution and focused on the emerging markets, all this money goes to developing countries. And last financial year, fiscal year 2020, that ended in June, over 30% of our commitments are related to climate, and close to 40% of that is actually in either countries. It's clearly the COVID has dealt unprecedented setback to worldwide effort to kind of fighting extreme poverty. And it has been projected by the World Bank that additional 110, 150 million people will have fallen back to extreme poverty by 2021. So it has been called an epidemic of inequality. And as we're reflecting sort of how this year has been for us, I cannot help thinking about March, where IFC actually announced an 8 billion package, COVID response package. And following that, we went to the market and issued a social bond, came to the market with a social bond. We received an overwhelming investor support, multiple times oversubscribed. It has been our largest social bond issuance. It's 1 billion. But the most amazing part of it, it happened during the most volatile day in the market. And you can see that the investors actually very keen to support those efforts to either to fight the threat of climate change, or to support the efforts to relieve to support COVID-19 relief efforts. So, and as you reflect, so we have two parts to the equations, right? So we actually have to have projects to invest in, and we have to actually have money to invest in. It's actually interesting, the later, considering that and the number of investors kind of signing up different pledges is accounting to trillions. And also on the emerging markets, you also have trillions dollars of opportunities, but they still need to translate into bankable projects, what we call bankable projects. And it has been an issue, flagged as an issue for a number of years. So what actually has been happening within NFC over the past few years, sorry, Shana, if you're saying you're unmuted.
Sorry, Elena, apologies. I'm going to say this is the fundamental issue, right? I mean, we have a situation where we have vast investor demand for green bonds and for social bonds, even though the rule set's still being developed, and sustainability and pandemic bonds, but we don't have enough things to finance, and even IFC doesn't have things to finance. This is the critical.
Exactly. So you have the money. It's not really a question of money, right?
So and how do we fix that?
For issuers, we would be happy to issue more. We just need projects to be financed. So we have addressed it, and actually that tied up to the capital increase that IFC have received, is the whole issue of creating projects. So instead of sort of waiting for the projects to come in, IFC is investing heavily, reorganized itself into creating those projects. So at this point, creating upstream projects, dedicating, sometimes there are some projects take years to be developed, working with the regulators to enable that environment for the projects to become bankable. That's where our efforts are right now. And right now we have about 5 billion of projects in the pipeline. We expect that it will quickly, that number will quickly become bigger, considering that we actually have hired quite a number of staff. And as I understand, I think there are some positions still open for those of you who are interested.
You heard it here, everyone.
Upstream work.
Apply now, apply now.
Apply now, yes. So we are very hopeful. So as we take our experience of an issue, of an investor, technical advice, we take it all with us and we take it to developing countries and we create those projects.
So this is critically important. Now, you know, as a proud European, the EIB, our European bank, has now become a climate bank, which means 50% of all investments have to be climate focused and the rest have to be screened to make sure they're not working against climate. The EBRD adopted a similar strategy recently. We're seeing changes in development banks around the world. We're seeing increase in climate lending through all the major multinationals, and IFC's certainly been a leader. I mean, don't get me wrong. They're not perfect yet. Julie said this. They're not perfect yet. We want them to be greener and do more. We would like 100% of all lending at the IFC to be put through a climate filter. But the change is right before our very eyes. It's really happening now. And of course, in Europe, we've seen the Recovery and Resilience Fund, which is saying it's going to issue about 200 or 200 plus billion euros of green bonds to fund that fund. For those of you who don't know, 750 billion fund, euro fund, a third going to green, but the other 2/3, which is a mixture of grants and loans that member states can get out of the Commission, has to also be argued as supporting improved resilience of those societies. So the whole lot of the fund really is relevant to the discussion we're having today. Bear that in mind. And there are do no significant harm provisions too. You can't invest something to support resilience that does major harm in an area of important to European policy, such as climate change. So there are some interesting discussions to be had over the next 2 years that come through. But that's going to be, in its own right, $200 billion of green bonds coming out. And of course, the funds should lead to deal flow generation. But we don't have enough now. Jeroen, you've been trying to place money around the world. You're lucky enough, I mean, I have to say, full marks to PGGM to give you a mandate. Is this the problem you're having too, that Elena talks about? Lack of deal flow, lack of actually place to put your money? And what sort of discussions are you having about resolving it at a sovereign level?
The supply in EM sovereign markets is not that big. It's more of a supply rather than a demand issue. And most of the supply is in the dollar market. So I think Thailand this year became, let's say Nigeria was the first sovereign to issue green bonds in the domestic currency, but they were relatively small. And Nigeria has another issue around accessibility. But Thailand recently tried to issue a very large sustainability bond, which actually was 1/3 a pure green bond, but 2/3 was a handout to SMEs. And there's still debate by various verification companies about whether this is a eligible sustainability bond or green bond. Obviously, by including those SME handouts, it kind of undermined what was happening in the green component, because the green component was a very good one. It was the extension of the Bangkok metro railway system. That bond would have been a much bigger success had it been just a pure green bond. And issuers also need to understand the delicacies of benchmarks. The CBI is obviously verifying bonds for the JP Morgan index family, which covers EM corporate bonds, but also EM sovereign bonds. Had it been a verified green bond in the ESG version of the index, it would get a higher weight, meaning attracts more capital, it reduces interest rate costs for the issuer. So I think a lot of sovereigns don't have that sharp in their minds yet, but that is another important thing for them to look at.
That's a critical view. Julie, in your exchange, you're now going global. You're getting issuance listing, you're working in multiple markets, including in Asia. Can you tell us a little bit about what you see happening from an emerging market side, and whether you see it? I appreciate your market is largely European, but just picking up this question of the supply issue and how you see that traveling.
Yeah. So what I can tell from China is that what we did and the role we tried to play as an exchange was to encourage Chinese bond issuers, issuing mainly domestically, to try to comply with international standards, being CBI verified and following some international standards like ICMA, to be sure that they can also raise interest of the global or international investor community. I have to say that with some policy bank like ADBC, it's quite a success, because after huge amounts of domestic green bonds or poverty alleviation bonds, they managed to go on internationally and to raise the interest of international investor community by making sure that they can convert towards these standards. So we are trying, by encouraging domestic Chinese issuers, for instance, to comply with international standards. We are also helping Chinese and domestic standards to converge with international standards. What I see as well, or what I heard about emerging countries, is the bigger difficulty they face compared to Europe, for instance, in terms of data, in terms of collating data and complying with our standards of pre-issuance and post-issuance reports, for instance. So giving some transparency where they crucially lack those important data is one of the biggest challenge, from what I understand.
A very good point. And places like China, it is a real challenge. But of course, in China, we're lucky because we've got the central government pushing hard on this question. And we've had some significant developments in green finance. I don't know whether people realize, but China is currently one of the world's largest green bond markets. Depending on whether you're counting CBI or Chinese figures, it's either number 1, number 2, or number 3. Krista, you might clarify that for us in a minute. But the key point is it's grown from 0 at the beginning of 2015. The China banking regulator introduced green credit guidelines to try and push banks to make green loans with the help of IFC colleagues of Elena's many years ago, in 2007, 2008, in fact, and they continue to work on those. The PBOC, the central bank, has brought out regulations for green bonds and brought out incentives. If you're a mid-level bank in China and you post green bonds at the liquidity lending window of the central bank, you get a 1% discount on wholesale funds. Whoa! I can tell you what, UniCredit would like to get that in Europe. So there are a range of other incentives as well in the Chinese market. So as a result, we have a very significant growth of green bonds. We also have a lot of green loans, thanks to the CBIRC, the banking regulator push more than 10 years ago. In fact, my friend Marjun at Tsinghua University thinks there are 10 times as many green loans as green bonds. Now, is it enough? No, like in Europe, it's not enough. Is it making a difference? Yes, it has helped pushing markets and creating positive energy and, frankly, preferential pricing for green investments. Has it gone to overseas lending? Not so much yet, but literally just in the last couple of months, the banking regulator has published much tougher guidelines for international issuance and international lending by Chinese banks to the Belt and Road. So that'll flow through in the next year. We'll see how we go with that. So that's one area of the domestic market, but of course, of the emerging market. But of course, the other sectors are places like India. We have seen some significant, substantial green bond issuance out of India, as well as places like India. Krista, India continues to publish. The State Bank of India, I think we've had Renew issue a $500 million bond just in the last couple of weeks, haven't we?
Yeah, that's right. And there's increasing activity also in the social and sustainability space there, and overall in the emerging markets. And I wanted to add to something you said about China, because we're talking about sovereigns and sovereign transitions. As we all know, China also published a very ambitious decarbonization by 2060 targets with the peak emissions at 2030, which will require huge capital to fund. And concurrently, they're also working on greening the Belt and Road Initiative. So it'd be really interesting to see and I'm expecting quite significant effects there for the whole sustainable debt market in the emerging markets under China's leadership there. So that'll be a really interesting thematic development to follow. Also, as we've seen recent sort of unlabeled product developments related to sovereign debt. There was just recently, I think last week, an ETF from BlackRock that tracks an index from FTSE Russell looking at climate-weighted sovereign debt that isn't labeled. So when we start looking into that and connecting the dots to the overall transition, like in the case of China, that's when it gets really interesting to see where we can move capital and what is then the sort of role and developments of the labeled bond or broader debt markets in light of that. Do we see more labeling, or do we see a shift in other ways?
What do you think? I mean, I think, Julie, you've already said you think we're going to see more labeling. Jeroen? Is this an unstoppable train?
I think so, yeah. We've seen the SDG-linked bond by Mexico, by the sovereign, where the UNDP helped them as well. That's the first in its kind of, although the Korean one is in a similar fashion. We've seen blue bonds by Fiji, but we think there are some more projects down the line. I've also seen questions around something backing a nuclear power project, which is obviously a very gray area. And then the SDG-linked bonds. I think similar in fashion to what Suzano did, the Brazilian pulp and paper company, they were the first EM corporate to issue a bond that has links to its carbon intensity. If they achieve a certain target by 2025 or 2026, the coupon would go down or up. Sorry, if they fail, the coupon would step up as a compensation for the investors, because the risk profile of the company is higher. But ideally, in the next few years, we would see more EM sovereigns issuing green bonds, but the green bonds would also have an embedded SDG-linked structure to say use of proceeds go towards this, and in addition, our target is to reduce X, Y, Z. If we don't achieve it, there may be a coupon adjustment. And I think we could make it even better by if you include this debt forgiveness discussion, the DSSI, which has been ongoing in a lot of emerging market countries. And one asset manager in America put an interesting idea forward that to put a clause in a bond, in a sovereign bond, to say if there's a pandemic, there's automatically 2 coupon payments can be skipped, but the investor gets that in kind later on. So it immediately relieves their financing burden if a new pandemic strikes. So what if you could include all those 3 components? So a green bond with use of proceeds and reporting, then the sustainability-linked structure to say you need to achieve X, Y, Z, and then also the payment in kind structure to help them should a pandemic hit. I think that would be the holy grail that we should strive for.
So I think Julia and Elena, Jeroen's just laid down the gauntlet to the G20. I think he's laid out a very concrete proposal which should be picked up, right? But this is an interesting idea. We've seen the growth of sustainability linked bonds, only a small number. We've seen a lot of sustainability linked loans around the world. And we published the report only last week in Australia, for example, around how it's grown in that market. The bond stuff is just beginning to go. Are the ambitions adequate? The Suzano one is quite good. In fact, I'm sitting down with the CFO next week to talk about it. It looks like good. I'm not sure whether the NL, a great company, but whether the ambition of the actual sustainability linked bond was strong enough. But it's going to happen, Julie, isn't it? Like this is another market that's just going to burst. But what do you think about this idea of combining green and SSL?
Well, I just picked up what Jeroen and Elena said earlier on about the lack of projects and the need for IFC to create upstreaming projects. The problem of linked to social impact metrics within social bond, and the need to have a more holistic view of what the issue is doing. In addition to that, the problem is that not every issuer is in a position to issue green, social, or sustainability bonds, given their specific business scope. And that's the reason why the growth of green finance today still does not match with the enormous transition challenge we face. So I think that we need to find ways to finance not only isolated green projects or social projects, but also to take into consideration the overall sustainable strategy of an issuer. And I heard yesterday that investors are now interested in the transformation of the issuer, in a holistic transformation of the strategy of the issuer, rather than in its projects and expenditures only. But transition, of course, needs to be defined along with the Paris Climate Agreement. It cannot be business as usual, and you have already said so many times, Sean. So issuers should establish indeed clear targets on the medium and long term, and that's why as well corporate level disclosures are really needed for the climate transition.
Elena, what do you think?
Yeah, so I mean, I'm hearing, what Julie has mentioned. I would agree. There is going to be investors, and there is going to be more focus on DNA, on ESG DNA of an issuer as a company. But at the same time, there's going to be investors that will continue to have appetite for use of projects green and social. There's going to be investors that will want the sustainability linked bonds or some kind of combination, as Jeroen has mentioned, green and the performance links in it. So I think we're gonna see the proliferation of different labels, different types of instruments, but what we're also going to see, what's actually mentioned in the final part of your report, is the feedback loops. We're going to start seeing which one of those instruments working for what types of investors, what types of issuance. But there is one thing that will definitely take place, and that's the train that's unstoppable, is for finance to be transparent and to be accountable. And if I can bring in just one more aspect into the discussions, even though I don't think we have much time to discuss it, is we are talking about issuers, we're talking about investors, we're talking about the projects. One big piece of the financial markets is the underwriters. So just talking about the ESG credentials of underwriters, I think this is going to be the next big thing.
Are you having a poke at the banks, Elena? Is that what you're doing?
Well, actually, that's what we have done. So we actually came out with ESG survey, and it actually right now influences our choice of underwriters in our transactions. Wow. That survey that was sent out to our 40 plus dealers, and we're going to be using it as a tool. We're using it as a tool for in-depth engagement with our underwriters, just to understand, to go beyond the product offering by the underwriters, is actually what they are doing as a company.
So, Jeroen, we're going to have to take a guess about which underwriters get knocked off the list then. That's kind of a fascinating discussion.
And you can add to that as well the development banks owned by certain countries and what they are financing. And lastly, on the issuer side, another interesting part would be in the next few years how sovereigns, this is particular to sovereigns, how sovereigns develop their own capabilities to do auction processes of thematic bonds. Because right now, a lot of the sovereigns in emerging market countries, both the IBRD and IDA countries, are dollar bonds. So that means they are advised by one of the major banks. But they obviously have a domestic market as well. But there they typically run the auction process itself. And I think for them, they feel a hurdle to issue a thematic bond in the domestic currency, because then suddenly a lot more of the work and burden is on themselves. But maybe some of the development banks can help these sovereigns in building a process and a framework to do that more easily.
Which is one of the things you pushed on a lot. And in case you don't know out there, PGGM has appetite for local currency sovereign bonds, at least in some emerging markets. But Jeroen will have to figure out, if you approach him, which ones count. But that is a fantastic development. And we're seeing this in a bunch of fund managers now. I guess it's because of risk appetite and yield appetite is better able to be managed now at a sovereign level, Jeroen. But in the context of another 2 years of massive levels of sovereign issuance going forward, this is going to be really important. And the question to you, Jeroen, is whether the reporting and transparency provisions, given the volume of sovereign issuance coming through, are so attractive as an extra feature that you will see differentiation between vanilla and thematic in terms of the nature of investor appetite, similar to what we've already seen in green. Is this going to grow? I mean, are we going to see every government hustling to try and get sovereign issuance, thematic issuance accepted now because of the extra advantages?
I think so. You're seeing that there are more asset managers raising dedicated strategies for only thematic bonds. So the only thing they do is buy thematic bonds. They may not buy everything, but at least they only fish in the pond of thematic bonds. We don't have such a strategy, but we look at both. So if there are 10 more clients demanding with an ESG or a green strategy, and they are 10 additional investors that subscribe to your new issue, that probably means, ceteris paribus, that you're going to get a lower pricing.
Fantastic. We've got to wrap up. I'm going to ask the three of you, the four of you, in fact, and Krista, are we making a difference? How are we making a difference in all of this? Because it's come up a few times recently, including in a report from BIS, your reflections on the future. You're in this. I want to say to our audience, you've heard a lot of stuff today. You've heard about the need for ambition. Julie mentioned the Paris Agreement lines. We need ambition in what we're doing. As Jeroen said, with the social bond, we've got to critique and make sure that what's being done here really is contributing. The taxonomy work we're doing in Europe is an attempt to try and support that, a common language of ambition. Europe has resolutely stuck so far to a science-based approach, that taxonomy, very different to national climate change plans or previous climate change plans. It's an incredible contribution to the discussion globally, but it's still a fight. If you're a European citizen, please support the taxonomy. We need to start looking at economic development plans. The merging of development and climate and resilience in the context of the pandemic is now vital. It needs to be one story, not multiple stories. That requires us in places like Europe to think about what our economic opportunity and role is in the context of the world we have to change the next 10 years. Where's the business going to be? What kind of businesses will rise out of Europe? What kind of business opportunities rise out in South Africa, in Chile, in China, and focus on these going forward? Otherwise, we won't get the transition. We don't make it a positive opportunity going forward. So there's a hell of a lot of work done. But the question back to you guys, we've done this thing, we've got to market. What do you think about the prospects of making a real difference from where we are now? Elena first.
I'm actually quite optimistic about where we're going now. I mean, your question is the original question, are we making a difference, right? So yep. The question that has been asked for, I don't know, a number of years already. So, and I think the answer becomes more firmly, yes. I mean, the whole market that started with green bonds, it's a framework of how you have a discussion about integrity, accountability, transparency. And now we are taking it and expanding it to wider finance.
Julie, I know you've got to jump off, so if you do, go, please.
Yes, I completely agree with what Elena said. Transparency is clearly key, but if we want to make a bigger difference, maybe we should also emphasize education and access to meaningful data. For me, those are really key to the growth of sustainable finance.
Jeroen?
Yeah, I think I also want to answer a question that was posed by one of the people that was a bit more skeptical after having viewed many webinars in the last 6 months. I think this development will continue, but I think the asset management industry as a whole could also do more to, first of all, understand how a lot of the green bond frameworks and standards that you have developed work. What are the nuances between the different type of bonds, so they can interrogate when such an issue comes to the market. And also they need to just ask more issuers to consider a thematic bond. And especially in the sovereign space, that happens very, very little. So there are a couple of papers around engaging with sovereigns in the pipeline by the PRI, by the World Bank, and they're coming out very shortly. And I think that will hopefully give a lot of asset managers a guide in their hand to now start asking more sovereigns, like, have you given consideration to green bonds, to sustainability bonds, etc.
Krista.
I can only echo what everyone's already said, and we're also publishing a paper on sovereigns in January, so stay tuned for that. I think we're at the edge of a revolution here, really. I think following the conversations and the volume coming out of various segments, now is the moment. And this kind of crisis, like the pandemic that we're experiencing now, is opportune for bringing people together and making a tangible difference. And I think we've got so much. We've done the steepest part of the learning curve in setting definitions and understanding transparency and data, that now it's still, we need to do work, but it's much easier to bring it all together than it was a decade ago. Definitely.
So you heard Krista say we're at the edge of a revolution. I think you've heard our other speakers kind of get around that point too. We've established the foundation. It is not a solution yet. Emissions grew globally over the last 30 years at a faster rate than the previous 150 years. The IPCC tells us we have to reduce emissions by 55% on average globally in the next 10 years to have even a reasonable chance of our children having some kind of future. That's the challenge ahead of us. And while we're at it, because we've messed up the last 30 years, we have to address resilience, because our societies are going to get buffeted, like the last year in pandemics, which has been brutal in so many parts of the world, but also like the floods in Bangladesh only a few weeks ago, where Sheikh Hasina, the Prime Minister, said a third of the country was underwater. These are the bushfires in California. These are going to become frequent. We have to prepare. It'll require us working collaboratively globally. It'll require us addressing resilience and the SDGs, which you indicate as resilience. It's a big job. We've laid a foundation. We've got enthusiasm. We've got capital markets excited. We've got the money beginning to move and saying what solutions, and we need the money. We have the money. We have $100 trillion in institutional investment capital that wants to shift to green and social and sustainable if it's given the opportunity. And IFC's proven this already in the past. We just have to now act on the foundation we built, make sure the revolution does happen, make sure those emissions do go down, and we build resilient societies that we'll be proud to live in, that will work for our children. So we've only just begun. Good luck, everyone. The clock is ticking. Thank you so much for joining us today, Jeroen, Julie, Elena, Krista. Thank you, everyone, for being interested in this report. Read it, look at the recommendations for the future, but above all, work for change. Thank you.
Thank you.